Welcome to the Simply Safe Dividends channel. I'm your host, Brian Bollinger. Rising interest rates have weighed on many dividend stocks over the last 2 years or so. But with inflation and economic growth both showing signs of cooling, the Fed is widely expected to start lowering rates at its next meeting in September. In today's video, I'll review what investments worked well during past easing cycles, and I'll also highlight some dividend stocks that could look interesting if rates do finally start coming down, which could happen pretty quickly if we get a recession, or it could play out a little more gradually over several years if the economy remains on solid footing. At a high level, this chart from Hartford Funds plots the Fed's short-term interest rate over the past century. Rates impact everything from borrowing costs to asset valuations, so the Fed will periodically move rates up or down to try and keep inflation near its 2% target while supporting a solid labor market. The 22 yellow dots on this chart mark each time the Fed started to lower interest rates to try and support economic growth and avoid tipping into a recession, which is indicated by the gray bars on the chart. You can see that's not an easy job since the recession has followed around half of the initial rate cut events we've seen throughout most of history, including each of the last 3 easing cycles, which were capped off by the pandemic in 2020, the 2008 financial crisis, and the bursting of the dot-com bubble in the early 2000s. Despite this mixed track record, some investors get really excited about rate cuts since they assume lower rates and looser financial conditions will always push stocks higher. The reality isn't so clear-cut though. This rather psychedelic chart from Ned Davis Research shows the path the S&P 500 took 1 year before and 1 year after each initial rate cut since 1970, with the dark blue line representing the average path. Stocks have generally increased following the Fed's first rate cut, but there's a lot of variance here, so it's hard to draw many firm conclusions. At the end of the day, the market's near-term performance and the types of dividend stocks that do best often depend the most on what happens to the economy. Looking at each rate cut cycle since 1965, JP Morgan split the market's next 12 months of performance out by whether the economy entered a recession, which is marked by the light blue line here, or if the economy continued plugging along for a soft landing, as shown in orange. It's a rather obvious takeaway, but stocks do a lot better following an initial rate cut when the Fed manages to fend off a downturn. They had about an average return of 15% in the year after the first cut in these soft landing scenarios. The unfortunate part, though, is that I don't really believe anyone can forecast recessions or really any macroeconomic data point with any consistent level of accuracy, so this observation isn't very actionable when it comes to managing your portfolio. Now, I promise I'm going to talk about specific dividend stocks very soon, but I want to first emphasize that Fed rate cuts and even the event of a recession don't really matter that much when you zoom out. A lot of analysts like to chatter about what could happen next month or even next year, but you risk missing the forest for the trees with that type of mindset. Since 1970, the S&P 500 has always been up 5 years after the Fed's initial rate cut, and the performance difference between periods with and without recessions is probably a lot smaller than you might think. The dark blue bars here show the market's average return after the Fed cuts with the recession happening in the next year, while the light blue bars are periods where rate cutting cycles resulted in no recession, basically the soft landing scenario. Over the 5 years following an initial rate cut, these scenarios had average returns of 84% and 97%, which are pretty similar for how different the economy's path was in year 1. The bottom line is that Fed rate cuts don't really change the long-term outlook for stocks all that much, and even though the initial period around these policy pivots can be volatile, most buy and hold investors have no business changing their plans in anticipation of what could happen next. If you have a dividend portfolio, chances are you already own some stocks that will likely do well if a recession or a soft landing follows shortly after the Fed starts cutting rates. Ned Davis Research published an interesting report this summer that looked at how different types of dividend stocks performed when the Fed needed to cut rates quickly in response to growing economic concerns and when rates were reduced more gradually with no recession on the horizon. The study plotted the relative return of faster growing dividend stocks against those with higher yields. So a rising line indicates fast growers outperforming the high income plays and vice versa. We aren't dealing with a large sample size here since the chart only captures 10 easing cycles, but you can see that stocks with the fastest dividend growth outperformed high yield stocks by a decent margin the first 6 months of slow easing cycles, but the opposite was true when the Fed had to rapidly cut rates, with this orange line falling here. This isn't a very surprising finding since recessions usually bring about a safety trade that sees bond-like stocks such as utilities outperform. We saw this play out in the 2008 financial crisis and the dot-com crash when defensive areas like consumer staples and healthcare were among the relatively best performing sectors from the time the S&P 500 peaked until it bottomed out around 2 years later in both of those downturns. Whether we get a soft landing or a recession, companies capable of delivering consistent dividend growth have usually been a good bet. This chart from asset manager Columbia shows the performance after rate cuts based on a stock's dividend policy, with dividend growers here in dark blue, all dividend payers in light blue, non-dividend payers in gold, and an equal weighted version of the S&P 500 in gray. Following rate cuts, dividend growers outperformed all other groups over each time period up to 3 years after the initial rate cut. Who knows if history will repeat this time, but owning quality businesses that sell essential products and grow their cash flow and dividends is a pretty simple strategy to create income and preserve wealth over time. I used our website Simply Safe Dividends to screen for dividend stocks that could do well if the Fed ends up cutting rates faster than the market expects, which would likely be due to a recession. I'll start by adding a filter to look at only companies that have a safe or very safe dividend safety score. If you're unfamiliar, our dividend safety scores are how we spend most of our time each week, and they've been around since 2015. We maintain the only real-time track record out there that shows you how all of the 800 plus dividend cuts that have occurred were rated by us. So you can see the dividend safety score we gave a company next to the cut announcement to see the predicted value of these ratings. And the takeaway is that if you stuck with companies that had safe or very safe ratings, you'd have avoided at least 97% of all of these dividend cuts. So it's a good way to filter out some lower quality companies that could really run into hard times, especially if the tide goes out with the economy. I'm going to also look at companies that yield at least 3%, so focusing on kind of higher yielding stocks. And from there we go. I'll look at defensive sectors like telecom, staples, healthcare, utilities. I'm also going to prioritize companies that have raised their dividend every year for at least 20 straight years. That gets us through the pandemic and the financial crisis. And finally, I'll add a filter for recession return, looking for stocks that meaningfully outperformed the S&P 500 during the 2008 financial crisis. You can see that over here in the recession return column. So that gives us 21 stocks that matches that set of filters, ranging from 3% to about 5% yields. The higher yielding stocks are mostly utilities, which is a sector that's really underperformed the last couple of years, with rates rising, making bonds more attractive, and investors just flocking to faster growing tech stocks for the most part. So I think utilities in general is an interesting space. WEC Energy is one of the utilities stocks that I own, one of my favorites in the space, for an idea there. Otherwise, I think the consumer staples area is interesting to hunt for ideas. Pepsi is a company that I like and I own in my portfolio. You can see the safety score of 93 for the dividend is solid. Pepsi's valuation is kind of trading at a discount compared to where the stock has usually been the last 5 years, with a higher yield and a lower P ratio. The company itself is a great earnings grower. You can see the company's profits have almost doubled over the last decade, which is pretty good for a company as big as Pepsi operating in a market that doesn't really grow a whole lot. Snack and beverage consumption is kind of tied to population growth mostly. Shares have also raised their dividend for 51 straight years at a pretty healthy clip, averaging 7% annual growth the last 5 years. This is a really recession-resistant business. During the financial crisis, Pepsi's sales dipped less than 1%. And while the stock did fall 35%, the S&P 500 lost 55% during that same time. Right now, people are a little disappointed on Pepsi's volume growth. Some of the consumers are starting to pull back a little bit. In North America, snacks and beverages, Pepsi saw around 3-4% volume declines in recent quarters as consumers are trading down to some of the cheaper options like store brand products. But at the end of the day, Pepsi is really good at knowing how to price, package, and promote its brands, which I think will keep the company relevant, generating cash, and growing as it innovates in different categories as well to adapt to changing consumer habits. So it's really not a company that I worry about if there is a downturn. I think it could do quite well if rates come down and investors are looking for some safety options. Another stock I'll highlight in this group is ADM, Archer Daniels Midland. So if you followed this company, it's kind of more complicated one to understand. It's involved with procuring and processing lots of different commodities like corn and soybeans, really around the world. It was rocked by an accounting issue earlier this year where basically one of the company's segments, one of its smaller segments, was misreporting some of its inter-segment sales. So kind of a unique issue that doesn't really seem to have any implications long-term for the company's health or accounting quality, really. But it caused the stock to drop a lot earlier this year. Lower crop prices have also weighed on this business. But at the end of the day, people still need to eat. ADM has been around for 125 years. It has a massive network of grain terminals, barges, semi-trailers, rail cars, things that are very hard to replicate that make it one of the lowest cost providers for what it does. So I think this is a business that is kind of built to last and again plays on the need that people have to eat. Crop prices aren't always so correlated with the economy either. So during the financial crisis, this stock only dropped 21%, raised the dividend, and it's maintained its dividend for over 90 years, growing it for 48 straight years at a pretty decent clip too, kind of mid-single digit growth the last 5 years, 11% hike in January after the accounting scandal was announced. So I like ADM as kind of an out-of-favor stock that's dealing with some cyclical pressures, some accounting noise, but seems to have a long-term outlook that's intact and offers a good yield that could be more attractive if rates do fall quickly and there is a recession, which again shouldn't have as much impact on the types of products and services that ADM provides. So I will go ahead and save this screen as fast rate cuts recession. And I will start another screen here that will look at the other scenario. What if we get a soft landing, right, where rates kind of come down more gradually over time, the economy hangs in there and does all right? I'll still start by looking at safe and very safe rated stocks. I'm going to limit this to no higher than a 4% yield. And I'm going to optimize for dividend growth on this screen. So we kind of saw with the historical studies that dividend growth, especially faster rates, do better if there is going to be a soft landing scenario. So I'll look at companies that have raised their payout by at least 12% most recently in the past year. I'm also going to require at least 5 straight years of dividend growth. Over the last 5 years, I'm going to ask for the dividend to have been increased by at least 12% per year on average. I'm also going to put in a screen for valuation, really basic. Show me stocks that have a P ratio that's in line with or below their 5-year average. So we're kind of weeding out some of the stuff that might have done really, really well the last couple of years with this risk-on mood in the market. That gives us 15 matches here, so a pretty manageable list to look through. Again, 12% minimum growth in the dividend. A couple of these companies have been closer to 20%. Pretty impressive. If you look at some companies that stand out to me, Sherwin-Williams and Carlisle would both benefit if rates started to come down gradually because these businesses, in Sherwin-Williams' case, one of the biggest paint companies out there. So a lot of their end demand is tied to activity in construction markets like housing and commercial construction as well. Lower rates make it more palatable to finance construction projects. So you could see Sherwin-Williams see higher demand, which would be good for them. Even without that happening, I mean, the company's done a great job of growing its earnings, which have basically quadrupled over the last decade and are expected to continue rising 11% in the year ahead. Company has a really good balance sheet with pretty moderate to low debt levels, and the dividend has grown for 45 straight years. So I think Sherwin-Williams could benefit if we do get that soft landing. Same with Carlisle, which makes roofing and insulation materials, so construction activity, which would be favorable with lower rates, no recession, would bode well for Carlisle. Visa and MasterCard are two other interesting names to consider here. So if there is a soft landing and rates come down, that makes it, again, easier for consumers and businesses to borrow more. There's going to be more spending and economic activity, which means more payment transactions and more fees for these network providers. So Visa is a really impressive company, super consistent dividend growth, averaging kind of mid-teens per year over the last decade. Payout's been hiked every year since it was initiated in 2008. The stock trades at a slight discount to where it's been over the last 5 years on average as well. So not as crazy of a valuation as some of these AI plays out there, trading at 25 times earnings with pretty consistent double-digit earnings growth. So just a great business with an excellent balance sheet as well, with pretty much no debt on the books, nearly a 70% operating margin, very stable. So Visa and MasterCard are two other ones that stand out to me if you believe in kind of more gradual rate cuts and a soft landing scenario. One more I'll highlight is ADP, Automatic Data Processing. This company provides a lot of payroll processing and human resources, software and services to tons of different companies that are increasingly outsourcing these things. If you think about a soft landing scenario for ADP, it bode well for employment growth, right? So if you're avoiding a recession, you're not having mass layoffs, there's more need to process payroll and have other HR services outsourced. Even during the financial crisis, though, this is kind of surprising. Sales only fell 3% for this business. The stock biggest drawdown was 29% when the S&P 500 crashed. So it benefits from having a lot of recurring revenue from these software and services that make for a very sticky cash flow stream and a dividend that has grown at 12% per year over the last 20 years, 5 years, and most recently in November. So a very, very consistent company. Valuation is about in line with where it usually trades, and earnings are continuing to grow. Even with the labor market cooling, profits are expected to increase about 9% in the year ahead. ADP has a great balance sheet, again, with pretty much no debt. So these are some companies that I think would be good ones to look at if rate cuts are more gradual and we avoid recession. But even if we did hit a recession, these are just great companies that generate awesome cash flow, have excellent entrenched positions in their markets, and long-term track records of creating a lot of value for their shareholders. As headlines about rate cuts pick up over the next month or so, I hope this video gave you some helpful perspective on how to think about this news and hopefully tune out most of it. I think quality dividend growth stocks are a decent place to be for the long term, no matter what happens with rates or the current economic cycle. If you enjoyed this video, it would really help me if you hit the like button below and considered subscribing to our channel for regular dividend stock analysis and income investing tips without all the nonsense that's unfortunately out there. If you have your own dividend portfolio, you might also want to check out our website, simplysafedividends.com, for research and tools that thousands of investors rely on each day to keep their income safer and their retirements on track. It's free to try and it only takes a minute to sign up. I'll put a link down in the description below. Once you're in, you can get started with tracking your dividend portfolio's safety and income stream. You can read our stock research. You can screen for different ideas, download our latest newsletter. You can quickly vet stock ideas based on quality, valuation, safety, and a whole lot more. Thanks again for watching, and I hope to catch you next time.